Hey everybody, welcome to another Thursday. Hey, we have officially entered well, I guess we did last week too, the fourth quarter. So happy fourth quarter to everybody. Um, as you guys are ramping on here, just a reminder, please use the Q&A to hit us up with questions. And also you can use the chat to harass and harangue us. Adam is getting a shot in his back right now, so hopefully he will be joining us here soon, but we've got stuff to cover in his absence. We will not be as good or as funny or as dry-witted as Adam, but we will try to keep you informed and entertained along the way. So before I hit it over to Jack, I had a couple conversations this morning and yesterday with some bankers and getting their feelers on, what's happening, and is our recommendation, have our recommendations of like waiting been in line with what they're seeing and what they are guiding people as well. And I would say 100% of the responses so far, at least from my surveys of a few, have been, yeah, you guys are right on the money. So I got this from Andrew Krasinski this morning of PNC. So quick shout out to Andrew, but I thought this was pretty interesting. He said that technically, and this is what they're sending to clients, their portal opened on August 10th and only 96,000 applications have been submitted for SBA review out of 4.9 million loans. So think about that, only 2.1%. The SBA hasn't started reviewing any of those loans as of today, and PNC submitted 176 applications to the SBA from their 73,000 plus PPP clients. So that's interesting. And one of the things that I thought that was helpful, regardless of who your bank is, this is something that PNC is doing, and that they are recommending to go through a review process with them so that they can help kind of streamline the process when they say, yeah, it's time to go ahead and open the gates and submit. And they're doing first in, first out basis. But I thought that was really pretty solid. The other thing that he told me was they expect that the smaller banks, kind of like in the original applications, will be the ones kind of running circles around the big banks, just because they don't have the same amount of volume, and they're not going to be probably as worried, not that they're not concerned about it, but the big banks are big targets for the Fed, it seems like. So the big banks are going to be a lot more cautious. They've got a lot more risk on the line, and they've got a lot more volume. And so it'll probably be like, the little banks have the chainsaws going out, and then once the big chipper gets, fired up by the big banks, then they'll be going through some wood pretty fast. So anyway, that's it from there. And then also, I thought this was interesting from Brian Redd at Pinnacle. They're seeing, and they're saying as well, wait until the last minute, just given all the ambiguity that's going on. I've also been asking these guys, what are you seeing in the marketplace? They're seeing multi-family housing construction, and that thing still very strong. They're also concerned about retail. You guys are probably seeing this as well, that credit is tightening. The bigger banks in particular, I think they're battening down the hatches a little bit just to make sure they don't get burned. So anyway, those are some of the highlights, if you will, from my travels and my conversations with regional banks. So thank you for everybody who's sent some questions in last night as well as this morning. I see those. We will address those. Jack, do you have any thoughts about some of the research that you've done?
Yeah, absolutely. So a couple things to bring you guys some sanity. See if this sounds familiar. So that is the sanity of the mornings I every time this year, about this time of year, during an election year, I think about how happy I am and would be to hear the car commercials and find out all the wonderful cars that I might own sometime in the future from Scott Clark Toyota. And then this is another song that if you transpose, but it's a good groovy song too. That was Everyday People. This is People Every Day. And then I'm not going to tell you who sings this version of it. She was a heavy metal rocker, and it was
I
a
like
Captain
that.
car. So
As a drummer, I really like that.
yeah. So after the first week in November, we'll get our car commercials back, and I think everything will be normal on morning news. A couple things. So yes, I had heard similar statistics as far as the amount of loans that are going out, the lack, the forgiveness and issues, and how many have been put into the process. The banks are at different places, whether they're accepting them or not accepting them. They're not processing them regardless. And so I have different facts and statistics about that, but it's pretty much the same, which is, and comments by people that say, I thought one was pretty interesting. Every time she sees a new email from her lender, I pretty much drop everything I'm doing. I go and check to see, is the portal open yet? Oh, it's not. Okay. So, this kind of anxiety that we get from seeing these notifications on our phones from the bank saying, yeah, we're still thinking about you, but nothing really has happened yet. So we have that. I want to, I found some information actually in a kind of a PPP article that is related to Main Street. And we've talked about that a little bit, but not very much because we've been focusing on PPP. And people are trying to figure out why. Let's see, it says about 2 billion of the available 600 billion, 2 billion out of $600 billion has been approved. And part of the problem is that the SBA is not all in. They are only all in as far as 95%. And so banks are on the hook for 5% of the loans, essentially, if they go into default. And similarly, there's not a whole lot of structure or reassurances to the banks with respect to the loans and with respect to what is the bank's responsibility under certain circumstances, as far as vetting them, as far as going through the process. Another interesting statistic, almost 75% of the respondents, now I don't know what the data set is in here, but they had made no Main Street loans, and we're talking about banks, or were not registered for the program. Banks that declined to participate in the program mentioned their ability to provide credit to eligible borrowers without the program, as well as unattractive key program terms for lenders as reasons for not registering. So that may be part of the explanation, but there's just not a whole lot of movement going on in the Main Street lending program. There is, I have an update on the changes in ownership. As far as we talked about that with respect to M&A transactions that are in process. And I found a pretty good summary of it. I have the actual procedural notice that is the SBA official, but I found a good summary, and it basically goes into, first of all, the change in ownership. Is it essentially an asset sale or a stock sale? And then they have thresholds: sale or transfer of at least 20%. Of at least 50%, or a merger, are the categories. And then required procedures to a change in ownership, whether or not you have to get SBA approval or not get SBA approval. So there's the approval issue. And then if approval is not required, you still have to notify the bank that the transaction is going through. Then you get into the issues of, you have in M&A transaction, you have the assets, the assets of the company A and the assets of company B that are A is being acquired by B on assets, or there's a merger, a stock sale or transfer or transaction, and both have loans. So what do you do now? it is clear that you have to keep them separate, that you can't merge them together. And so basically what you would likely see is either keeping separate books and records, even of a merged company, or keeping that separate asset and that separate liability, because you will not have gotten forgiveness yet. So you would be, I think, and now I'm getting into your world, Gary, and Adam's world, as far as what you do on a balance sheet for that. But I would imagine you'd have both of the listed assets if you haven't consumed all of the PPP money, but definitely have the liabilities for both loans on your balance sheet. So that is a Jack theory, and hopefully that's correct. And so basically you just need to notify your lenders and submit your forgiveness and do it for both. So that is, there's a lot more to that, but I just wanted to give you a quick summary of that. And with that, I think that's all of the other stuff that I have to share.
So I'm going to read a little bit of this, and then I'm going to pass it back to you, Jack. But we got a note from Michelle last night, and she said, hey, I figured it'd be easier to send this question in an email to get answered on tomorrow's webinar. The question is the email legit? And, you know, they're a healthcare provider, and they're talking about additional funding released on phase 3 general distribution, but it is in the Health Resources and Services Administration, HRSA, and there's a provider relief fund. And so Jack, did you have a chance to do any sleuthing on that?
Yeah, so the program is legit. I looked into it a little bit, and I reached out to some of our health law attorneys, and while they gave me some of the details and pointed me in the right direction of the program, the link to the program. So while I don't have precise knowledge about the program, it seems like that we're in phase 3 of that, and the phases are directed to the types of organizations that are entitled to get this help. And so stage 3 or phase 3, its reach is a little broader as far as the type of facilities, whether it's assisted care facilities and those kind of things. So it is, and I would suggest though that the email look legit, and actually I think I may have clicked on the link in that email, but I would go directly to the source and find out, because in there they have links to the application process. They have a frequently asked questions page. They discuss who is qualified and really provide a lot of guidance, more so than with other programs. So I was kind of surprised to see all of this detail into that, but it's also run by a different group of people, a different organization necessarily, so governmental organization. So my suggestion is to check that out and see if you qualify. Walk through it like you've done with the PPP programs, through the application process, and see where you end up. I don't know with the program administration, is it the first in, first out, or is it by a lottery? So again, I don't know the details of the program, but it is a legit program. But with everything else that we've said, you know, go to the source. Don't click upon any links that are in the email. You know, if they say they're with a certain organization, go to that organization's webpage. It may be that it's legit. There are some really good fake stuff out there that will look like, and even pulls images from the legit site and puts it on their own website. So there's a lot of fraud going on, a lot of deception. So please do go to the source and make sure you are at the source. So even if it looks like, I don't know, it could be that the link says sba.gov and it really goes to sba.net. The legitimate fake ones, which are the ones that look like they're government, and I say legit only because it actually is a legitimate business that will, for example, help you through the PPP process or help you through this process or that process. They will charge you a fee for that. but they try to use domains that sound very official sounding. And that happens here, that happens in the trademark world too. I know a lot of you have received, likely if you own federal trademarks, you receive that letter that comes in the mail about a year before you actually have to do anything and says, hey, for this fee, by the way, this is from the US Trademark Office. I've seen that one, and it's a Washington, D.C. address, and it looks very official. It has, an eagle, looks like an official seal, but it's not. And so this is a long-winded way of saying, just make sure you're at the right place before you start giving up information.
Great advice.
Yep, go ahead.
So we've got a couple questions. Thanks for addressing Michelle's thing. And Michelle, if you need additional information, we can, find you the right people over at Jack's Place or whatever. But I think his advice is the way to roll. First question in the gate today is from Jim, and he said, for employees who had a salary of greater than 100,000 in 2019, can we reduce their salary by more than 25% without impacting the amount of forgiveness?
So good question, because you're meeting the requirement of getting the salary greater than $100,000, but it causes you're tripping over another wire. Remember that the $100,000 is a penalty for forgiveness, or it is an amount that is a benchmark for qualification. And so, and the 25% is a qualification for forgiveness. And so you need to put it into the mix of the formula on the sheet and see what the output is, but without going through the math, and maybe you can come back to that and Adam can give some reassurances, but I think that you will be penalized because it's more than 25%. So you go with the fact that the salary is greater than 100, and that impacts the amount of forgiveness versus being penalized. So it's a penalty on either side of it, but it's a penalty that's directed to a different variable. And so, like I said, go through the formulas and the spreadsheet and see where you end up.
All right, cool. And what I would just ask Jim, in case Adam is not able to get out of the doctor's office fast enough for this thing, send me an email and send it also to FAQ@trustbgw.com, FAQ@trustbgw.com. We still have an expert desk that mans that. And my email is gfrey@trustbgw.com. So FAQ@trustbgw.com would be a good place to just be double safe, okay? The next question is from Stephanie. Hi, I've not been on here in about 2 months. Shame on you, Stephanie. What have you been doing? Running a business? Last thing I heard was a loan of anything under 150K could potentially not need to do forgiveness. Is that true?
So the lawyerly answer is maybe. And actually glad you brought this up, because it's something that I wanted to bring up before in kind of my opening comments, which is found another article, and it was a discussion of the kind of the psychology of things and the psychology of business owners and people going through forgiveness or thinking about forgiveness. And so the comments were, the country is still waiting to see if Congress will offer more pandemic assistance. And part of that was a more streamlined forgiveness form for loans under 150K. And then also something we've been talking about, which is that expenses paid with PPP dollars will remain tax deductible expenses or not. And so you have a bunch of individuals, you have a bunch of trade groups just doing everything they can, asking, pleading, begging, praying that Congress will provide some guidance. And it's just that there is just no way that's going to happen before the election, I think. again, Jack theory. I just don't think there's stuff going on behind the scenes. It's not completely paralyzed. You have teams of people that are working on things. And that brings me to what the House did or proposed, I think partially to throw the ball back to the White House and specifically to Congress, to the Senate, that, hey, we've done what we can and we've put something out there, but it still has to go to the floor, and it hasn't. But I want to reiterate a comment that I made 1 or 2 sessions ago about one of the reasons why this is completely stalled. And I want to give you just the highlight of, so this is a press release regarding the bill that was put in front of the House related to COVID-19 stuff. But that's where the PPP and the CARES Act programs and stuff, that's where it's going to be modified. So you have things like, and they're all good and legitimate things, but the problem is that the more things you put into a bill, the more discussion, the more debate, the more, well, that's not enough for this. Well, and then there's negotiation. Well, I'll agree to this higher amount if you agree, a bunch of back scratching going on. So you have medical equipment for first responders. You have protecting renters and homeowners from evictions and foreclosures. You have protecting people experiencing homelessness, suspending negative credit reporting and strengthening consumer protections, protecting student borrowers, standing up for small business, minority-owned businesses and nonprofits. You have empowering community financial institutions. There is providing assistance for state, territory, tribal, and local governments, support for a robust global response to the COVID-19 pandemic, providing oversight and protecting taxpayers, and on and on and on. So that is why this is going nowhere. That is why there is a proposal, there's several proposals to focus just on the businesses and the business impact and not all this other stuff. So to have a mini CARES Act for business owners. And of course, each side has its own version of what that might look like. And that is also the problem. So I don't think that anything is going, again, not to be doom and gloom. I'm just sharing kind of the reality and what I see going on in our economy and with respect to these packages. So that's where we're at. But that's and going back to the original question, we don't know what the benchmark is, if it's 150, if that's going to pass. It seems like it would be logical for that, just because that would take care of a lot of the loans. So a high percentage of loans are within that frame, or at least less than $1 million, less than $500,000. And so that would take care of that. But then you still have the issue of fraud. And then you have the issue of the lenders. What is their responsibility? If it looks like fraud, if it just looking at stuff, do they have a responsibility, or the banks just completely off the hook for doing any due diligence, even for those $150,000 loans? So again, lots of factors and variables into making that decision and setting that benchmark. But the key part of that has to be that the banks have been given a get out of jail card, or don't even go to jail card, if all they have to do is say, here is the group of our $150,000 or less loans that we intend on notifying the borrowers that it is forgiven, you're all good to go, and be done with it. I think there's going to be at least a minimum, we've talked about this before, a minimum reporting requirement, whether it's mailing an electronic postcard and making certain certifications. That way they have you not only lying on the actual application, but you are affirming that lie and that fraud. And so they can really hit you harder with certain federal and state laws that say that, when you compound a lie, when you certify a lie and increase the level of fraud, shame on you, and we're going to come back to you harder than just having the original lie and fraud. Is kind of like the Cliff Notes version of how that works.
Yeah, that's good. One of the bankers that I talked to, it was his theory, and I won't disclose his name, but he thought that because of the volume and because of another banker was on a call with Ernst & Young this morning, or EY, and they said that the applications that they've seen so far run from multi-page volumes of mess to too simplified on the other extreme. And because of that incongruity, he's like, man, I think they're going to have to even get down to, if it's $50,000 or less, it's like slide it through, you know. So who knows, stay tuned, but don't make any assumptions at this point. And that's why I think, you know, our initial guidance, which has been hang tight, get your stuff in order. If you need to, go talk with your banker, make sure that you've got your T's crossed and your I's dotted, so that when the gates seem like that they're open and there's more clarity, then you can sail through it a little bit easier. So anyway, next question is from Scott. I was told that there may be a question as to whether or not a company can qualify for the extended 24-week period if its payroll frequency is only once a month. Is there anything to that? It doesn't make sense, and I'm hoping there's nothing to it.
So I think there may be kind of a mixture of concepts there. So that the qualification, the 8 or 24-week period, first of all, if you, depending on the time of the loan, you may not even be able to use the 8-week period. It's the people that were kind of earlier on that may have the option to go one way or another. And so as far as qualifying for the extended period, that is the factor of qualification. And so the fact that payroll frequency is only once a month has to do with, you know, you go into, well, you know, what is the pay at that time? So, and I don't remember what the cutoff date is at this point. I can, you know, if Adam were here to stall, I could go look at my papers, but since he's not, you know, I don't know what the cutoff date is, but I think that, you know, the payroll frequency, once a month would, in fact, I think, allow you to, once you notify of that then you have to do some numbers and interpolation and everything else to make sure the numbers are correct, depending on what, so, you know, it gets extended to the end, of the pay period, or it gets pushed backwards to the beginning of the prior, you know, when the pay relates to, as far as the pay period goes. So I don't think you need to get kind of worked up on, or not, I shouldn't say worked up, concerned with those two things, because they're while they're interrelated, they are different concepts with respect to that.
So Scott added on here, he said this was approved and funded on 4/24. So
yeah, I don't remember. I think I want to say that the switch between the 8 and 24-week period, or the availability of that, came after that date, but don't hold me to that. I'd have to look that up. So sorry.
So what I would do on that, Scott, is if you have an outside payroll provider, I'd go to them and ask for that clarification. I know ADP has been pretty good about, and we know pretty much all those payroll providers, but they've been pretty good about being proactive with communication and that sort of thing. So if you do have an outside payroll provider, I would go to them. And then if we have still not been able to answer your question appropriately, hit us up at FAQ@trustbgw.com, and then copy me on it too. Again, GFREY@trustbgw.com. And we'll try to make sure that you're answered there. Any other questions out there? Thanks to Chris, for the affirmation to Jack and his adroit answers. So thank you. Any other questions out there? It looks like, Adam, I don't know what would happen in the doctor's office to be delayed, but he may have been delayed for his shot in his back.
See, I
And
should have bet you. I didn't think, I knew he wasn't going to. At 11:30, 11 o'clock appointment, even at that point, they get backed up. They have additional, procedures, et cetera. And so, yeah. So,
yeah, he was supposed to
but
be on at 10:40. So maybe the doctor will see him now, and it's 11:31. So any other questions out there before we sign off on this week's crazy train? It's
while we're waiting, I'll throw out a couple things unrelated to PPP, but just kind of interesting current events. So, as we know, there are going to be challenges to asserting a claim for force majeure or your business interruption insurance. There's going to be pushback by insurance carriers. There was a case out west somewhere, and I can't remember if it was Arizona, that the insured, so the policy holder, was successful, at least at the trial court level, and I'm sure it's going to get appealed, that they were able to claim and was essentially awarded a claim for damages that was essentially COVID related. So the shutdown as being the business interruption, and notwithstanding, it's not a physical business interruption. And I don't know what the policy said. I don't know what the arguments were. So, not trying to get everybody all excited that that's what's to come. That is just something that happened. As far as force majeure, I would suggest that at least in all contracts that I'm putting together, the force majeure clause does have epidemic and pandemic in there. And also, for example, in new leases, we are, on behalf of the tenant, negotiating a COVID related issue. So for example, if it's a new build and, or, there's a recognition that there's going to be reduction in business. So you have negotiations of the rate, you have negotiations of the potential term, meaning that there is a potential termination, and the cause being the fact that COVID-19 has not allowed for opening, or there's reduced opening. And it obviously depends on the business and the industry, but don't be shy about negotiating things like that, because you as business owners, as tenants, have leverage to do that. I apologize to any landlords that are on the call but I've had to negotiate that on behalf of landlords and sometimes dial it back, but most landlords are, okay, let me get someone in here that at least will pay some rent, because they may have a debt load on their own mortgage for the strip mall or the building or whatever it may be. And so let's get someone in there and get the business going, so that way they might be able to generate revenue. With there is disparate restrictions or lifting of restrictions between North Carolina and South Carolina, which are also very interesting. I don't know if you've heard that over the weekend, when South Carolina lifted their ban so restaurants can go full capacity, there were people that were not very happy about it. And so I was listening to the news this morning that, back to kind of the days where the hostess or host would ask you for smoking or non-smoking. Now they ask you for COVID or non-COVID space, meaning socially distanced. So they're creating these spaces to attract customers who want to be socially distanced. What is ironic about that, though, is, and I've seen this, and I've been personally very careful about where I go out to eat, which is not very often, usually doing a lot of takeout, which is that while you might be sitting in a socially distanced place, once you order an adult beverage, if people are hanging out 3 deep at the bar and the bartender is dealing with all those people who maybe not be wearing masks, then, what is the exposure level there? So I drink a lot of water and tea when I'm out and save the adult beverages for home, just personally speaking. So anyway, just again, a few business thoughts, a few personal thoughts. And so looks like maybe I've delayed
Yeah.
long enough to get some more questions in.
Yeah, exactly. You did a really good job. Couple things. So the first one in here is from Harvey. If you have qualified business expenses that are way more than your PPP loan, say the loan is $1 million and qualified expenses over 24 weeks is 1.6 million, but you had some reduction in FTE employees that came to 200,000 in forgiveness reduction, would you still get full forgiveness on your $1 million loan as your qualified expenses were so high?
Okay, so love you guys, but I'm not going to do the math. That's what spreadsheets are for, et cetera. Now, having said that two things. One is that we've been talking about in the past about what might happen in bucket number 2, meaning the second program that comes eventually, hopefully into this year, maybe into 2021, and does it have some reversion back? So that way, when you have qualified expenses that exceed the loan, does somehow that excess get put into a different program with different parameters? So that's one of the reasons why that maybe you don't seek forgiveness at this point. And so as far as getting full forgiveness, it is, if just because you've expended more, but it sounds like in the question that you've expended up to the level of 100% forgiveness, but you've just expended more, and potentially those expenses would be forgivable, but it's not part of your loan. So you're saying, in essence, that I have an overage on what would otherwise be qualifying expenses. So if the government had given me the money, I would have been 100% covered in forgiveness for that higher amount. So again, to me, that's a situation where maybe maybe you wait and see, or maybe if you're 100% on the million or whatever the number was, that you go ahead and get your forgiveness for that. And then, but the thing is that, and I can't really think of an example, but if there is something that is, let's say, for example, that the rules for the 60-40 split, let's say it's 50-50 in the next set, and they do integrate or commingle the programs, and you could get even a higher rate of forgiveness when you commingle those expenses together. So that's why you may also want to wait and see what the second program is, because you are asking for forgiveness based upon a set of rules that you are abiding by. But if they change the rules of the entire program, then you may have a higher benefit of forgiveness down the road. So that may be a reason why I'd hold on to not seeking the forgiveness, although it's not going to go anywhere in the near future anyway, regardless if you're able to put it into the bank's portal.
All right, next question. This is from Carrie, and it's actually, Carrie's one of my colleagues. Hey, Carrie. One of our clients has a question. This company leases medical equipment. And the question is would we be able to include our vent leases in the PPP category for leases on personal property?
Gosh, I'd have to look and see what the interpretation of personal property and with respect to leases. Then you also have a question of who is the lessor? Is it a related party? A lot of times you have companies a holding company that will buy the equipment and then lease it back, because there's some benefits in doing things like that with respect to more expensive equipment under certain circumstances. You have a lot of heavy equipment dealers and that do have that kind of program. And so I honestly don't know the specific answer to that question.
Yeah, the equipment, Carrie just chimed in, the equipment is being leased to their customers.
Okay, so you have a company that is the lessor. So they likely own the equipment, or they have some sort of floor plan with the manufacturer of the equipment. So the question is, include those leases for leases on personal property, but it sounds like that is this company is the lessor, not the lessee, so it's not incurring an expense, I think. So maybe I'm getting it wrong, but it sounds like that the company that we're talking about is the lessor. It's like the landlord, and so is receiving revenue, and it's not an expense necessarily. Now, expenses on the leased equipment, like if it's used and has to be refurbished and other things, that may qualify. So just need to know maybe more about that situation to be able to answer that.
Yeah, and what I had mentioned to Carrie, and this kind of goes to anybody else, is if there is a question that we either have not given the clarity that you needed, or you hadn't asked the question, hit us up again at FAQ@trustbgw.com, and typically we'll have an answer within 24 to 48 hours on that. Right now, since we've got the last push of the October 15 deadline for C Corps and personal extensions, we're going to have a little bit slower response than normal, just knowing that that is crashing upon us right now. Hopefully that has answered it. Okay. Thank you, Carrie. Great to see you here. And then Tim led, sorry, Tim. Tim had said anything what you expect on SBA loans and EIDL. And, we talked a little bit on the front end, and he was a little bit late getting in. You have anything that you'd add to what we're hypothesizing?
Not really. I would just suggest to, rewind the tape from today to go through some things. The reality is there's not a whole lot of news. It's status quo. We can talk about speculation. I mean, news specifically on forgiveness. I mean, there's other stuff that we talked about over the past 40 minutes or so. So, but I also want to go back to, as far as the lease question, also to consider, there's different treatment for capital leases as well. When you have, essentially, it's an option to buy, essentially. So it's characterized as a lease, but really it's kind of like an installment sale. So there's other issues related to that as well that you should look into.
All right, another question. This is from Greg, and it says, this may be for Adam, but since he's not there, we can push this until next week if needed. But I'd like to hear if you guys are recommending to your clients that have access to line of credits at higher interest rates to go on and apply and take if given a rapid recovery loan, and just put it on the BS on balance sheet, since there is an 18-month interest only deferral at 0.25% rate, then use the line of credit when you've run through the rapid recovery loan. Not sure if I have all the exact rate correct though. You have any thoughts on that?
Yeah, I'm out. See ya. No, Craig, I wouldn't venture to, there's a lot of numbers in there. And as far as the program goes, as far as the RRL, I'm not as familiar with that. So I would be doing you a disservice by even giving you jack theories on that. As far as, just generally applying for loan facilities, what we've been telling clients is that, it just depends on where you are and what your needs are and your needs for survivability. And that if you have to take that opportunity or if you can wait, it's great that there is that opportunity, because we have lots of clients that are either already extended to the max or close to it on the letter of credit, or are just saying we're not going to, they've thrown in the towel as far as taking on more debt. For example, we have clients who are being offered different terms and conditions for leases, so amendments to their leases, but then it's not really it's not forgiveness on the lease side of things, and that's between landlord and tenant. I'm talking about forgiveness. but it is, well, let's put it on the back end, or let's extend the lease terms, or, you know, let's do these kind of things. And, or in one instance, it was interesting because there's some TI money that is floating around. It's like, well, let's use the TI money since you're not proceeding with necessarily doing the upfit or the upgrades, and let's use that money. But essentially the arrangement is that, well, that's really, they're just borrowing money against themselves. And so, you know, and then they'll have this debt down the road of repayment of the TI money. So it's an interesting way to kick the can down the road. But in this instance, the reality is, it's just that there's, why would I do that? Theoretically, it may be because that we don't know what's going to happen with forgiveness. We don't know what's going to happen with stimulus package number 2. So if there is a possibility of continuing increasing level of business for this particular business, or in one instance, in another instance, reopening of a hospitality, a restaurant that has been closed for many months now. And, you know, is it reality that that restaurant's going to open? So again, long-winded way of saying that it really just generally speaking, taking on more credit is in some cases it's just delaying the inevitable, possibly delaying a bankruptcy. But I get it also that if you have a personal guarantee and you can delay that moving forward, and getting hit on the personal guarantee for something, then maybe that's a reason to do it as well. So it really just depends on your personal and business circumstances as to how leveraged you already are in these kind of circumstances. So Greg, I didn't directly answer your question, but just basically just general conceptually, what you might or might not do.
You did what lawyers do, man. You dodged the question. I'm kidding.
Yeah, there was a lot of that last night on TV between 9 and 11 o'clock.
Yeah, for sure. Hey, Greg, if you need an answer faster, and you don't have Adam's email, feel free to use mine, and then also hit the FAQ at trustbgw.com. Otherwise, if you want to go into a little bit more detail on that, next week, hopefully Adam's back will be better, and he won't be in the doctor's office again. So hopefully that helps a little bit. Any other questions out there? You did a good job, Jack.
Thank you. I've been trying to practice not saying as many and ums and you know, so this was a good opportunity to practice that. I'll go back and look. You know, I don't
notice.
Do you go back and look at the tapes? I don't.
I cringe when I see myself on a recording, so not really.
Yeah.
All right. Well, hey, everybody, thank you so much for taking time. It's amazing to me that we still have as many people on these things as we do. And I think what we will probably see as this thing kind of lingers on, and we'll see how PPP and other COVID relief related programs, you know, ramp up or down. But, you know, we are in the fourth quarter, and we are here for business owners. And so this is a pretty cool opportunity, the way I look at it, that you've got access to a couple experts and a lackey like me that can give you some, you know, insights, if you will, for free. And we are really here to serve. So thank you again for entrusting us with some of your time. We will be back up on the BGW CPA YouTube channel. We'll get this thing up tonight. So Tim and anybody else that had to dial in a little bit late, you can review that. And thank you again. I think we are adjourned. Any last call for any last questions? You got 10 seconds.
Make some stuff up and send it to Adam. Some really bizarre stuff.
Yeah, exactly. All right, guys. Thanks so much. Hopefully we'll see you next weekend or next week. Have a great weekend. Bye-bye.
Thank you.